Hey, how's it going, guys? Welcome back to mentfx, and in this video I want to talk about the power of the Fibonacci tool and how to properly use it with the proper levels and how to best use it to accommodate your trading, your bias, and your execution. Now, before we get into it, very quickly, just so you all understand, the only way you can get into my mentorship is this website here, launchpass.com/mentfx/mentfx. There are fake Telegram channels. This is an example of one. This is a fake channel. I don't know how 8,000 of you, if it is you guys, I don't know how 8,000 of you are subscribed to this. This is all fake. This is not me. I did not make this. Anyone that gets scammed by this is absolutely fucking stupid. Literally, the only way that you can get contact of me is with the things available in my, description. So please don't be an idiot. Please don't get scammed by a Telegram that's fake, okay? You guys are not this dumb, and if you are, you do not deserve to be in the Forex market or deserve to be trading or, let alone, deserve to be making any fucking money. Now, back to the Fib tool. The best Fib levels and the best way to utilize the Fib is actually to take off almost everything and just have a 50% drawn on it. Here are the settings. That's how I do it. The best way is the 50%. Why? Because the 50% allows you to see the best areas within a range and the best areas within a certain supply or demand zone that can show you potential mitigations of a zone and where to expect those mitigations to occur. What do I mean by that? If we go ahead and take a look at almost any projection or any move that occurred in the past, right? Even from like up here somewhere, all it takes is for you to look at the 50% of the last up move before a down move, or the last down move before an up move to utilize and understand where the best possible entry criteria can be. So for instance, if we had been looking at this chart a long time ago, it doesn't really matter, and you had this shown as a supply zone, yes, this is an entire supply zone, yes, it's valid, and you can use it to trade. However, sometimes refinement can happen with just throwing on an easy Fib and showing you where the best type of refinement or mitigations of this zone can occur. Thereby, you have them, as you can see, right along the 50%, and that would become your better zone, and that's how you can anticipate Wyckoff to occur, Wyckoff to switch and change structure bearish. And again, if you ask yourself the question, where did this move come from? Well, the last up move before the down move, which technically is this whole thing right here, or in some cases can be argued to be this whole thing right here with the up move starting at this low right here. Now, similarly, this is a very large area, and the selling that would take place here would, again, it'd be fine, it's valid, and it goes, you know, if you wanted to aim for some liquidity here, 3.7. But just taking the extra step of refining it with a 50% of an overall zone allows you to refine that same trade to a 1 to 8 instead of a 1 to 3, thereby almost doubling the RR you can have on certain areas. Now, why is the 50% a good tool, and why should you begin to utilize it? Well, when there are orders sent into this market, especially by smart money, especially if smart money is accumulating a ton of orders. So, you know, if you have seen the previous videos, you understand that in this specific case, we're breaking higher, coming down, breaking higher, showing you breaks of structure, thereby creating liquidity at the highs, coming down, breaking higher, coming down, potentially breaking higher, so on and so forth. When we do this, and when smart money has to sell into positions before buying up, you have to recognize that they do this with a ton of orders. So, for instance, if we look at this on an 8-hour chart or something that's a little bit lower, we notice that on this whole up move, there's a ton of liquidity lying here. So when smart money goes ahead and sells through that liquidity right here and then buys back up, they're left in a ton of unmitigated positions that need to be closed, right? Now, those positions come from the last down moves before the up moves, which can be denoted by, let's say, this whole move right here. Right? When that happens, especially when you're on a higher time frame, you have to recognize that to create a zone that looks like this with a large down move before an up move, or in some cases a large up move like such before a down move, to create a zone like that, it requires a ton of orders to be sent into the market to sell down, to then be bought back up, a lot of orders to take the market much higher from here to then send it much, much lower. And when they do that, the orders that are in there need to be mitigated in the future. So it's not enough sometimes to just mitigate, right? And mitigation is closing orders in these areas. It's not enough to sometimes just tap into it, mitigate a few of those orders and continue. Sometimes that's what's going to happen, but oftentimes they'll need to come back to mitigate more of those orders because it's a higher time frame area. That means there's a lot more volume of lots, right, that were traded at those levels, which means there's a lot more positions on both sides of buy and sell that need to be closed when price returns to that area. And the best way to sometimes refine an area like that is because you understand there isn't just one order that smart money took here to take the market higher. What they did is they sold in heavily at these points here where there's liquidity. On this move down, they sold, and then sold heavily. Sell. And all these sells were met with tons of buys to take the market higher, right? At these lows. Now, as they do that, and they go and mitigate some of the positions here, they're just mitigating a few of those positions, right? Because there's positions here, all the way through, right? Maybe less down here because it takes less as the price comes much lower to push the market down since less people are becoming a participant. Now, when they come to mitigate some in these areas here, so these wicks that you see right here, you're more likely than not closing, you know, this order, maybe some of these orders, but you're still leaving behind hundreds of thousands, if not millions of lots of orders that were still unclosed or unmitigated in these zones. And the best way to view those orders or to understand where those orders might be for mitigation is to simply take the fib and to look at the 50% of that overall push. And again, you can notice exactly why and how these bodies are filling this area in. So if you're not refined yet to the point where you can go inside of this price action and notice an area like this red little box of where you can expect price to mitigate, then all you have to do is take this last down move for the up move and look at the 50% of it for a better mitigation. And instead of using this whole thing as a down move for an up move, now you can use this. Now you can use the 50% of it, right? Which is going to be from this down move right here, which is going to be this right here, which allows you to expect longer term bearishness on a push down like this, which means inside of this price action, if there are sells to be had, then you can catch those sells all the way down to that zone. What do I mean by that? Right? That means that on this entire push down, as it pushes lower and begins to break structure lower, right, you have supply zones that you can use to sell into. And again, notice how these supply zones form. So let's look at this on a little bit of a higher time frame, because again, bear with me, we're working with fractals, right? So very simply, structure begins to break lower, right? Where do those structural breaks come from? The last up move before the down move. Let's highlight that up move, and there it is. Now, instead of, again, looking to take an entry, if you are to take an entry off the sell right here, and look to set your stop loss just above the high, taking it all the way lower, potentially to these zones, again, recognizing that you're going to be partialing at lows, partialing at more lows, right? You're not just going to let this run, and then you're also going to be most likely moving your stop loss, moving your stop, moving your stop, moving your stop, moving your stop, then getting stopped out here or closing your position here. What you could also do is very simply understanding that you're on a 1 hour time frame and this area is quite large and it could come deeper. Instead of looking inside it to find all the unmitigated zones and all that stuff, drop a fib on it from the open to the wick, right? Make that your actual refined zone. And once again, you have a much better and refined entry that now runs about 1 to 25. And again, it's not going to be 25% because you are partialing along the way. Now, as you begin to break lower and use lower time frame entries, you're going to have to start using this fib tool a little bit less, because you have to recognize when you're looking at a 50% of an area, the reason you're using the 50% is because on a higher time frame, when there's a move like this, to take a look at that move on a lower time frame, it's most likely going to look a little bit something like this, right? There's going to be a ton of liquidity being engineered, created, most likely a Wyckoff, right? Taken out, comes up, maybe mitigates a little bit, doesn't mitigate, comes up, right? And this whole candle on its own, this down candle that might be, you know, shaded in black in this case because my candles are black, would look like this on a lower time frame, right? And instead of going into it to try and find every supply zone, every demand zone, one here, one here, one here that you can use to look for to be a buyer at, right? Instead, you can either take this whole thing right here and look for buys as price gets down there, like this, right? And you don't know where it's gonna go. Maybe it gives you a fake breakout, comes back in, right? And then really does begin the breakout and you get a buy-in. You can just refine it to the 50%, understanding that within this overall accumulation, within this overall higher time frame candle, there are a ton of orders that still need to be mitigated, and those orders can be at the open, but a lot of them can still exist in or around the 50%. And now, instead of having to use this entire area as a potential area of mitigation, you use just the lower areas here. So now you can already move your refined ones just from this one gets canceled, and you can use this zone and this zone, understanding that price can most likely come into the 50 or a little bit deeper and continue higher. Now, this will apply again, like I said, to the higher time time frame analysis. Why? Because the higher time frame is where the most orders are sent into the market, right? So again, if we go to the daily here, just to take another sweet and quick look at this, taking a look at what price did, instead of using, again, this entire down move before the up move like such, right? You can either go refine like I did, like this, right? And probably get a fantastic sniper area, POI, that price taps into and gives you an entry off of. Instead, you could do something as simple as taking the 50 and expecting price to come and tap an area like that and making your entire POI as simple as that. Similarly, if price is to come deeper, instead of looking at, again, an entire demand zone like this as the last down before the up move, you simply take the high to the low, and now you have a refined demand zone at this level here, expecting now and within line to see the run of this liquidity and potentially the fill of the imbalances here, right? And what's funny is sometimes even just jumping a 50% area like such will actually already refine you to a better lower time frame area. So what I mean by that is if we go to a 4 hour, notice what this refined us to. It refined us to a perfect last down move with a little bit of extra area taken into account before the up move. Now you have the same thing occur across all markets and across all time frames. If we go to Euro US dollar very quickly and even go to a monthly time frame, right? Notice how there was, right? Let's go to actually a 3-month time frame so we can see even more. Notice how at this break of structure right here, right? We had the last down move before the up move. All we had to do to take and refine the zone is to take it, find the 50% of it, and again, our entire zone is again just refined. Let's take that 50%, there we go, is refined to already this candle here, which, as you can already see, refines us to not the last, to like the last down move with a potential imbalance fill right before it, and the liquidity that can be taken, right? So as we get lower, we don't even have to do this to view it, but as we get lower, maybe to a weekly, right? As we get lower, we can see that we've refined it almost to the last perfect down move before the up move, right? If we go to a monthly, you'll see that it now refined it to the last down move before the up move. Similarly, take a look at this supply zone right here. If you weren't sure about how to trade the supply zone or where price wanted to reach up into, because of the fact, you have to ask yourself, what time frame are you on? Because of the fact you're on a monthly time frame, you need to recognize that inside of this candle, there was a ton of orders being sent into the market, right, to take price lower, which means that there might be sells that they've already been able to take out at profits, but also there's a ton of buys here that took liquidity before selling off, right? Or even sells that still need to be mitigated, right? So where will most of those mitigations occur? Usually the 50%. So again, if you drop from the wick to the wick, notice where price goes before it gives you the retrace. And again, on a lower time frame, had you been watching this, there was an ample opportunity to watch it tap in, right? Look at this. It begins to mitigate the open, but the real mitigations occur here. And that's where it again comes to grab the last highs before the real push down, giving you an overall Wyckoff schematic and giving you the opportunity to be part of the pushes lower, right? Now, what's funny about these pushes lower is, again, if you ask yourself about how this price was delivered, right? And ask yourselves about where the last up moves before the down moves were inside of all this stuff right here, right? So it's not always going to be the case. So I'm going to give an example right here. But theoretically, you had this last up move before the down move in this zone right here, right? Now, again, at the open is where this got tested. However, if you use the 50%, this is an example of where an order would not come to mitigate entirely. Now, that also means that in the future, prices can easily be reaching up to mitigate some more of the positions that exist right here. So this is also a way for you to gauge where price again may want to head. And if you remember the video on volume profile, which if you haven't seen it yet, you should check it out. If we look at the impulse from the top to the bottom, we notice that the low's volume again is found right here, right above this liquidity. And what do we see? Some of the higher volume was put in here, which means that even if prices do want to extend completely higher, on a lower time frame, we're probably going to see a good amount of mitigation that occurs right here, which gives you some ample opportunities to go short term before it either comes to take out new highs or begins to finally break structure and give us a institutional reason to go short on this, right? And again, as we zoom back out, we can take a look at this and see how it occurs over and over again. What I mean by that is, again, you can go into the past and take a look at some of these areas. Look at the supply zone, right? Last up move before the down move. Take the 50% of it, refined, and notice where price goes. Similarly, take the demand zone, extend it, right? Take the best fib tool you can use, take the 50, and look how it mitigates. And again, as you look at those mitigations on a lower time frame, you'll be less confused about these fake potential breakouts that break short-term structure, and instead look at this as an overall engineering of liquidity to, more likely than not, take prices lower, take out more, and then when you see real structural breaks that look the same as they did here on the 50%, you know that now you can expect bullishness to be delivered to you. And that's how prices can be anticipated and delivered to you in that sense. Okay, now again, we can zoom back out for a second, and just to prove that this goes across all let's go like this, and just to prove that this works across all and every single market, let's go down into the daily on Bitcoin right here, and again take a look at how refinements could have helped you get involved on some of these trades here. Now notice again, where's the last up move before the down move? Here, okay? Before this break of structure. So notice this broke structure right here, right? Where's the last up move? Right here, okay? And similarly, if you ask yourself about where's the 50%, take it from the wick to the wick. And again, this is not where it tapped, but had you used the body in this case, which is again, something I love about the 50% fib tool, if you use the body, you understand exactly where it goes. I don't use bodies, I use wicks, so do with that what you will. But if you're on the daily, for instance, and you looked at, for instance, an overall push of a range, right? Because on a higher time frame, this itself was its own large push that also had a ton of engineering of orders and unmitigated orders within it, right? Because on a weekly, as you'll see, or even on a monthly in this case, right? It's a little bit hard to see actually. You can't see it on either. Maybe on a 3-day, maybe on a 15-day chart. Take a look at this. 10-day chart. No, nothing there. You can't really see it. But if you understand how fractals work and how this entire push right here was responsible for taking out the highs here, so this is the push and the move down, then you understand that taking the 50% of this, of a range, will give you a very, very good idea as to where prices will want to mitigate. And if you know prices want to mitigate around this level, then you know that it's probably going to reach up for this imbalance. So sometimes the 50% will also help show you the general area where larger term mitigations can be expected, right? And again, where does this move push down to before this move up happens? The last down move before the up move right here. And again, instead of just looking at this as an overall area, recognizing that it's already been mitigated, you can ask yourself, where are the orders that still need to be mitigated? And those would exist here. And again, notice how as it taps into there, you have the wick rejections proving to you that not only are orders being mitigated, but there's also, more likely than not, large term accumulations occurring there, short term, to take you higher, right? Now, similarly, if you take a look at gold or anything of that sort, let's get rid of some of this stuff for now. Again, if you're unsure about what you want to aim for on gold, right? For instance, look at this last up move before the down move. What can you do? 50% it. In this case, it went way higher, but notice where the bodies are and where the wicks are. The wicks are coming to mitigate all the orders in here and quickly closing below the 50, because below the 50 is where they want to keep price if they want to continue taking price in a given direction. And this will work with almost any 50% of anything, right? You take a look at the last down move before the up move happened here. Take a look at the 50% of that. And again, you have an area that can already be refined where the wicks want to stay above, and then you have the mark up. Again, if we get onto a lower time frame, like an 8-hour or something, understand there's still a lot of orders in there. The last down move before the up move is seen where? Right here, right? Or if you want to argue, it could be this one, but this is the real last down move. Similarly, because it's an 8-hour chart, and again, always ask yourself about the time frame that you're looking at. Because it's an 8-hour chart, you can expect that mitigations could come deeper into the overall demand zone. And those deeper mitigations can be either refined with a much lower time frame entry that you might be able to find, or as simple as taking a fib tool from the open to the wick, both of the wicks, sorry, from wick to wick, and drawing that out, and now you know exactly where prices most likely want to head. Similarly, as price begins to break higher from these zones here, instead of just drawing out the zone and just trying to look for buys there, you can simply go and refine that zone to what? Bottom of the wick to the top of the wick, draw that down. And again, what happens? The wicks are the only thing that taps into that area, and the bodies close above, forming what? New demand zones. And as those demand zones are formed, right, notice where they hold. Again, higher time frame, more orders. You take it from the top of the wick to the low of the wick. And as you can see, very close. The wick didn't even hit it here, but that's okay. That's how prices can be delivered. Now, even when you're wrong about the overall direction, let's say you're bullish on this, or let's say you're bearish up here, but you're bullish on this overall. Even if you're wrong about the direction, this simple refinement process can still get you into very nice trades. How so? As price begins to break higher here and then begins to create intermediate term lows, lower highs, and then break structure, it leaves behind this supply zone, right? As you all know, the last up move before the down move. Now, again, you can see there's mitigations at the open, and then it begins to break structure even lower. But where are most of the orders that lie in here, especially since we're on a higher time frame? The 50%. Notice what the wicks do. The wicks touch, come close under. So what can you anticipate from that? You can anticipate that orders are still being mitigated in these areas to then take price lower. And if price is going to continue lower, based on the previous video that we released concerning structure and concerning how you can view liquidity and breaks to structure, right? Where would it want to target? Liquidity, which you can then also link up with the fact there's liquidity here, which you can also then take a step further and link up with the volume profile, showing you what? That there's the lowest volume here, which means this imbalance most likely will want to have some kind of fillage, as well as the run below this liquidity, and this liquidity. And notice where price runs. And what's even more interesting is, again, if we take the 50% of even this imbalance, just like that, you can again notice where price goes. Because the 50% is where the bulk of the last possible orders usually will lie that will see mitigations. So the 50% of an overall up move before a down move, or 50% of a potential target, or 50% of an imbalance is often going to be an area where price will either stop, mitigate, or in some cases, completely reverse. So you can use this as an extra tool to guide you, to show you where price may want to mitigate. And on top of that, if you do see wick mitigations that continue to close higher, then you can anticipate that on lower time frames, these areas like this will now act as accumulations on a lower time frame. And those accumulations will look like what? The same thing that we've spoken about in the past, with lows being taken out. And again, notice this. If you use that entire area, this break of structure right here might have tricked you out and taken you out, and you might have already started to be bearish without recognizing that the real orders lay under that 50% right here. So as those last orders were taken out and then structure really broke, that's where your entries hold. And again, even though we're on already a pretty low time frame, notice where the last down move before the up move was, right? Let's draw that out very quickly. The last down move before the up move, and notice where price mitigated. Go like this, and there you have the 50% mitigation. Again, there's no wick there, so maybe you want to go and confirm that on a lower time frame. And what do you think is going to occur in this area on a lower time frame? Well, you're more likely than not going to again see very, very small and short-term accumulations, as you see right here, right? Prices make lows, prices make lows. The weak hands that are getting in early are being taken out and transferred to the strong hands. Prices are moving higher. It comes to mitigate one more time to create a demand zone 2.0. And that demand zone 2.0, which is shown right here, right? Again, can be refined. How? With the same tool we've been using so far. And again, in this case, the prices are not returning there. Why? Because we're on a low enough time frame that there isn't a bulk of orders in this area, right? So that's when you want to start to use the actual overall zones. And that's very normal. Now, again, this 50% thing will be seen across all timeframes, across all markets. So right now, currently in a stock, right? I actually sent this sell out to a few friends of mine that got some options on these. But this is Verizon. It's a stock. Does not matter. This applies the exact same way to absolutely everything. As we had these breaks of structure, and again, if you don't remember this, I had a video released on some of this stuff earlier, but we had these breaks down on a much higher time frame. So we had these structural breaks right here, right? And then we had, again, a short-term structural break here, which we're expecting to come and meet lower prices. And with that expectation, we started creating inner-term bullishness, right? And again, those bullish areas were tested at around 50% of certain moves, right? Because on higher time frames, what do those areas act as? Large areas of demand that have a ton of orders in them that can usually be mitigated to about 50%. Okay, so as price came up and made this low and made this high, taking out all the liquidity, making a little distribution and breaking lower, what did I instantly do? There was instantly a sell sent, but also what did I do? I took a look at this last up move right here, right? This is the whole up move before the down move, which I think was on an 8-hour or maybe even on a daily, right? So yeah, this whole thing is its own up move before the down move. And if you look at that and you then take the 50% of that, just like this, right? Then what do you notice? Price comes to tap into that area ever so slightly, leaving behind wicks and doing what? Closing below. Wick closes, wick in, closes. So what are you going to anticipate is going to be in these areas? Even though it's a stock, there's most likely going to be Wyckoff that gets tested pretty nicely there. How so? Let's take a look at it. Let's go to a 15-minute chart here. And again, what do you see? You see highs being created, and those weak hands in the market that are selling in prematurely and early are getting taken out by the buyers and the strong hands that wicks right into our 50%. So again, you're on your hands until you see that 50% breached. As it's breached, price comes in from this high to this wick, right? Wick to wick, and breaks down. Where are potential entries? At the open, but because we're on a 15-minute, we most likely want to use the open. However, if you use the 50%, notice where prices went. Prices barely came to tap them. If you use the bodies, then you're good, right? But the idea here is showing you that the reason we didn't have a deep enough mitigation of the 50% is because this is a lower time frame, so there's not as many orders in that specific area that need to be mitigated, right? So as you can see, this is just showing you that you can expect the 50% of many areas to be the areas that might want to hold and might want to continue to be taken out. Again, 15-minute chart. In this case, the actual last up move before the down move, which can be viewed by this right here, had the same thing happen. And as it comes to wicket and closes under, what can you begin to anticipate on the lower time frames in here? The sell-offs, right? And that's what's happening here, right? Now again, where's price heading? If this is a break of structure higher and it wants to go lower, let's take a look and find if we can find a nice area of supply and demand. So there's a nice demand zone right here, right? Because that tapped into a larger time frame area, which again, without refining it like I did with this red zone, if you just drew the last down move before the up move like that, looked at the 50% from the wick to wick, drew that in, you've already refined it almost perfectly without having to go the extra step of doing what I did here, because the 50% of this overall down move on a 1-hour chart, hence many orders, was mitigated with this move here. Now again, where's that last down move before the up move? Right here. Right? Now, if you want to refine or look for the buys from these areas, if you just take the 50% of the wick to the wick, then you know that more likely than not, prices are going to look to wick these areas. And if there are wicks and closes, then you know that on a lower time frame, we're undergoing Wyckoff, and more likely than not will begin to run the next areas of liquidity, which are going to be shown by the structural breaks lower, right? Showing you that structure still wants to remain higher and start to break liquidity highs. Okay, and if you don't know what I'm talking about, please refer to the previous video where I spoke about knowing which structure to target as either liquidity or understanding which areas will function as the next break of structure, pretty much. Okay, so hopefully it's made some sense. Hopefully you understand why the only real good fib tool is the 50%, and that entries should not be used against, you know, the 6180, 7080, whatever it is levels. They can be, because there's always going to be pullbacks in the market that are going to hit some kind of retracement level. That's always been the case. But if you want to really make use of the fib tool, make use of the 50% and use it as a tool to refine the orders in an area to see where the last bulk of those orders on more likely than not higher timeframes are going to lie, to see where the real mitigations are going to occur and where Wyckoff will occur to take the weak hands and transfer them to the strong hands before taking the price in a direction that you have preset based on, more likely than not, your higher time frame bias that you've had marked out on a given currency pair or market. So thank you so much for watching, guys. I hope that made some sense. And again, the mentorship is only available at this website. Please do not get scammed by the other sites and telegrams available. And you can always get contact of me with the things in the description. Instagram is usually the best. So hopefully I'll see you guys in the next video, and I hope this influenced your understanding. Thank you.